All right, good day, everybody. It's been a minute. I've been out in Spain, just doing my holiday things, Uh, but we are back. I've been struggling to figure out what to record about and what to teach you guys, or get you guys more familiar with some of the concepts that like many of you desperately need, or something that needs to be known and that you need to have in the back of your head while you're trading. But I saw that Tom in our Discord has been doing like an SMC wiki, and I've just been scrolling through it and trying to figure out what I can to record about it. So everything that I'm about to teach you here is also in the Discord server, and there's a lot more in the Discord server that I have yet to teach about. So if you guys want to like learn it yourself without me having to explain it fully to you guys, even though I will sometimes in the future, but if you want to learn it like right now and use it tomorrow or maybe today, then just join up the Discord server and read through it, ask us questions, just everything you want, everything is there. But I came across CISD and SMR. This is something that I use like every minute, pretty much every minute. This is what I'm looking for all the time, even though like when I go into the market before market opens, I check the daily, I check the 12 hour, the 4 hour, the 30 minute. But this is something that you can see on every time frame. I mean, you see everything on every time frame because everything is fractal. But this is something that I keep in mind or in the back of my head when I'm looking for an entry and a high probable low risk entry. So I say we just get to it. I have another thing up here that I'll also read through, but this is something that you use to figure out if it's a liquidity sweep, a break of structure, or a false breakout. As retail traders, we use it. We call it inducement, but this is something you use to figure out if, oh, we're going lower, if we're going higher, or if we're just gonna stay in this range for the rest of the day. Let's just first quickly go over everything or read through this right now. You probably already read through this while I've been talking, but we'll just start by reading through this, and then we'll look over charts to find live actions that have happened in the market in the past few days, and I can explain why this was a liquidity sweep, and why this was a breaker structure, and why this wasn't a breaker structure, and it just kept retail traders out of the market, I guess. So CISD and SMR. CISD, or change in state of delivery, or SMR, smart money reversal, is where a buy program changes into a sell program or vice versa. Basically a reversal of trends. We can spot a CISD when we see an order block form, get traded into, and then move away in the opposite direction of the trend. When this happens, I'd like to see a displacement come with it, but of course it doesn't need to. But if I want to take the trade, I want to see displacement coming from it. A full SMR occurs when we had a CISD and then create a fair value gap or an inverse fair value gap opposite the trend, and then also have a breaker structure. The highest probability SMRs and CISDs occur after we hit a higher time frame level, such as liquidity. That means you need to have a bias before you go into the market. I know I haven't talked much about bias or the draw on liquidity. What I have told you is to just look through the higher time frames, so start from the monthly, weekly, or daily, and just start nitpicking at the market. Maybe find an order block that you might be interested in. Find a liquidity level. I mean, you have to find all the liquidity levels. Find a fair value gap, find an inverse fair value gap, find a breaker block, a mitigation block, and at the higher time frames, you mark out like 3 or 4 things that you find that we might draw towards. And when you go lower and lower and lower, you just add more and more and more. Just make sure your chart isn't cluttered. If it's cluttered, you're not gonna have a clear mind. You're gonna fuck up. You're gonna screw up, and your bias it's gotta be incorrect. So just start nitpicking things that are interested to you, and it might also be interested for the market. So full SMR occurs when we had a change in state of delivery and then create a fair value gap or an inverse fair value gap opposite the trend. The highest probability smart money reversal or change in state of delivery after we hit a higher time frame level is best to watch for a smart money reversal or change in state of delivery on a 5 minute or above for an intra trader. That's why I'm on the 5 minute right now. So I'm gonna just have this up here that we can go back and look for it. But let's just take a quick look at this news spike at 8:30. First of all, we have been having low resting or low resistant liquidity runs. I call it low resting. I don't know why I do that, but it just stuck with me. But these are all liquidity levels that are yet to be taken. They are called LRLR. The correct annotation? I guess annotation is low. Wait, what was it? Low resistance, yeah. Resistance liquidity run. I know this spelled incorrectly, but let's just, you know what I mean. So these are all sell side liquidities that we are looking to take out. I'm gonna just draw these out so you can see what we're up to. So we've been going higher and higher and higher. We have this massive fair value gap down here that we're probably gonna fill soon, maybe today. But we have this massive fair value gap here, but our main focus is this right here. We keep taking out buy side liquidity, right? So this is everything that we know that has happened. So it might be harder for you guys to spot this live. But right here, why wasn't this like a liquidity grab and go lower? It's because we kept going higher, right? We went up and there was no reaction over here. Retail traders would call this sellers are not involved, or sellers aren't active, or the bullish are still in the, or the buyers are still in the market, the bullish people are still in the market. So what we want to see is, like, if we have liquidity up here, right? Where's the arrow tool here? So if we have liquidity up here, we want like this to happen maybe, or we want like this to happen. It's just when we take liquidity, we immediately go down. But in this case right here, it just went up and then a little bit down and then continue higher. So that's why this is not a liquidity grab. So like this breaker structure is not a valid breaker structure because the sellers aren't involved. Same goes with here. We go like we tap it, go lower, and then we go higher and we close above it. If we don't get pretty much an immediate reaction after we take out this lower time frame liquidity, then the sellers aren't involved, as retail traders would call it, or your entry is not going to be valid. Like maybe, yeah, you could have taken this short right here. This bullish for value gap was close below. We had a bearish one up here, and you could have taken the short down to this level right here. 170 ticks, not bad, right? But overall, the bullish trend continues. Same goes with here. We don't get an immediate reaction after we take this level out. So sellers are not involved, right? Same goes with here, no immediate reaction. Same goes with here, no immediate reaction. This right here, you might consider this a like liquidity taken and we're going lower. But if you look more closely, it's actually just a consolidation range, and this was just inducement or a liquidity grab before going lower just to get us higher. So don't get blinded just by liquidity sweeps getting taken. Look at the bigger picture. Consolidation right here, consolidation right here. Like retail traders might see this right here as a break and a retest. That's what inducement, or what we sometimes trade. It's I don't remember what it's called, but retail traders will see this consolidation, breakout, and a retest to go long. But don't get blinded by liquidities only. You have to look at consolidations. You have to look at fair value gaps, higher time frame order blocks. That's why I want you to figure out the draw on liquidity. If the draw hasn't been met, then there's no reason for you to go short. Continue buying the trend. Just get your valid entry, like such as here, fair value gap over here, fair value gap over here, order blocks over here, consolidation, accumulation, manipulation into a fair value gap, distribution to the upside. This is the power of 3 right here, right? And then we get entry right here for longs. Stop like maybe below this level right here. This is intermediate term low, and you'd be aiming for, I don't know, something that's up here. You have to look at higher time frames back here. But this what we call inducement. So what the fuck is an inducement? Inducement, IDM, is a move that induces buyers or sellers into the market. This is to trap retail traders. They might call it a fake out, a fake breakout, but we just call it inducement. It's when it take a high or a low anywhere in the market. Breakout traders will use that high or low to enter into a position, right? We want people out of the market or into the market, and then we take them out so we can get our entry, our best entry, right? That's what smart money is. Breakout traders will use that high or low to enter into position if price breaks through that high or low. When we talk about and look for inducement, we are looking for high resting below an unmitigated PD array or low resting above or an unmitigated PD array. For example, if price makes a swing high, failing to rebalance the CB, then moves away, there's inducement on that high. Ununiform traders will see that high being an area of resistance, and once price breaks through it, they will go long. We will not go long. We will see that price induces traders into thinking that it's going to go higher, but in reality, it's going to rebalance the CB, then reverse and stop out the traders who went long on the breakout. So this right here would be a bearish scenario, right? Takes out a swing high to rebalance the CB, right? So I'll try to look for a short that also includes an inducement. All right, this right here would be the perfect inducement. We have a small accumulation right here during the London session. This is the 5-minute chart, so even though this looks small, this is still like, there's 5 1-minute candles in each of these candles. So this is a pretty good consolidation right here. So the retail traders would have like a trend line right here, a trend line right here. And then we finally get the breakout to the upside. People would go long right here, close above right here. They have that stop like right here maybe. But in reality, we're just filling, you know, this order block maybe, or this CB. And it continues lower to the sell side liquidity. Because this would be liquidity taken, displacement, break of structure, leaving behind the fair value gap and an order block. A high probability order block. What model is that? 2022 model. So for retail traders, they would go long. For us, we'd be taking the manipulation leg short. All right, back to the main bits. So that was inducement. I have now fully explained to you what an inducement is, and I guess I won't be needing that anymore. So let's go back to the SMR and change the state of delivery. So let's just take again this news manipulation leg. I forgot to talk about it, that's my fault. So we have a bullish candle or a bullish wick to the upside. It leaves behind a order block right here. It's actually a breaker block. We see that it goes down. We have a, let's just use this candle right here. We have a market structure shift. It leaves behind a fair value gap. It leaves behind a breaker block, a bearish breaker block. And we just start to consolidate in this range. We take out sell side liquidity right here. This would maybe be a long for somebody, but this is just a seek and destroy right here. We take out sell side, we take out buy side, and then we continue lower. But that's actually what you want to see. If you're looking for shorts, you want sell side taken out first, then buy side, and then we go lower. But what we would see is that we have a market structure shift. We have a breaker block that we can enter off of. There's also one right here. This is also a breaker block, but I would personally use the higher one because it's a bit less risk, 80 ticks. So it taps into the order block or the breaker block and it goes lower, right? So you could maybe enter off this fair value gap right here, this tiny 5-minute. You could do that. I personally wouldn't. What I would wait for happen is for the second market structure shift, which we have right here. We have a breakaway gap right here, and we have a bearish order block right here. I would take the entry maybe here. I would take the entry here, here. But my stop, if I would take the entry here, my stop would be at these equal highs up here, maybe a little bit higher, just so we can take them out before going lower. Like this stop is huge, but I'd be aiming for like all the way down here. So it's a 1 to 7 risk to reward, not bad, not bad. But if I were trading my actual PA's account, I would have waited for the fair value gap to get tapped into, and then my stop could be up here. So I wouldn't personally take this trade, but we have like a breaker block over here that we've been respecting, we've been accumulating inside of, right? So it's still a valid short. Like we have a breaker structure right here, continued lower, gave us an entry back in discount 50%, tapped the order block, continued lower, 300 ticks maybe. If you would have killed at the first liquidity, 200 ticks, right? So this is what change in state of delivery is. Displacement, market structure shift. There's no liquidity grab here, so you wouldn't enter off any of this. However, you would have entered off this. This is what change in state of delivery is, or SMR. It goes lower, it leaves behind an order block, you enter into the order block. Like it could have respected it here and then goes back into it. You could have entered this one or this one. But that's what it is, right? You just see the market is going to reverse because it goes lower. It disrespects bullish PDAs. We have a bullish order block here. We have bullish order blocks here. For bullish fair value gaps, right? It goes lower and it stops respecting bullish PDAs and starts respecting bearish PDAs. That's change the state of delivery, right? But that's what I keep looking out for. If my bias is bullish, I'm not going to be blinded by bearish PDAs. If my bias is bearish, I'm not going to be blinded by bullish PDAs. That's what change the state of delivery or smart money reversal is. That's all it is. An inducement, right? We have consolidation going on, and then go up, consolidation, go down. Retail traders would draw this as a trend line, like support and resistance, while we might maybe see a SIBI over here that we could enter off of. But the breakout traders would enter along here and get maybe have their stop like inside here or maybe below here, but they would get stopped out either way because the market's going to continue lower. It's simply accumulation, manipulation, distribution, but we call this inducement. Anyways, my name is AC. Take care.